Oh my God, you've never seen COMEX silver inventories fall 150 million ounces in just 5 months. The price went from $50 to $121. Oh my God, London's running out of silver. As London inventories of deliverable silver reduced, the London price rose relative to New York to the point where not only could you could buy in New York and sell in London and ship it back, it's given an opportunity for the hucksters in the Western silver market to say, oh, China's withholding their silver. China's not withholding their silver. China is struggling to get its new export license people up to speed as to what they need to do. You sort of see a plateauing of gold and silver prices. The Chinese gold market, China's the largest mining country, China's the largest gold refining country, China's the largest gold market for investment products and investment demand, and it has been the case. And China has a policy, the gold in China stays in China. 2 weeks ago, the EU and the UK said, you may not use our bases if you're going to attack Iran. And we attacked Iran anyway. So this was a unilateral action that basically said, we don't care what our traditional allies think. This is what we're doing.
Very interesting situation. So we'll be watching that unfold. And on that note, I want to go back to volatility and the increased volatility we're seeing not just in silver, but also in gold. I think people are used to seeing it as more stable. So in this bull market that we're in right now, do we need to expect more volatility for gold as well?
I think that you will, at least, at least for the next quarter or two. Our view is that you might get to a point where you sort of see a plateauing of gold and silver prices, staying high, preparing a base for another upward move. But in that kind of environment, the volatility could contract. You have to understand that with the high prices and the high volatility, that really puts a constraint, as I said earlier, on the flow of physical metal through the market. And that constraint will slow the demand and increase in price.
Well, let's talk about that then, because I think it's quite complex. People probably don't understand everything that's at play there. So that could act as a slowing influence on the price because of what's going on with the refineries, etc. Can you explain how that works?
Geopolitical disregard can ripple through markets far beyond headlines. The unilateral strike on Iran highlights the fragility of alliances, but as Jeffrey Christian points out here, gold and silver volatility is now entering a new phase, with prices plateauing to form a potential springboard for upward moves. High market prices constrain physical metal flows, slowing demand while feeding price pressure, and refineries struggle to meet the bottleneck. Investors used to stability must recalibrate expectations, balancing portfolio allocations with increased uncertainty. Next, Jeffrey Christian unravels how these constraints tangibly affect gold and silver market dynamics.
Well, there's several things. And it starts with the retail dealers and the wholesale dealers who sell precious metals to investors. And really for the last several years, you've seen heavy sales of silver back into the dealer market by investors who are taking advantage of higher silver prices. They had bought at earlier prices, the price went over $30, the price went over $40, the price went over $50, and they were taking advantage of that. But when the price went from $50 to $121, and even before that, in the summer of last year, you saw a tremendous amount of silver being sold by investors to take profits of prices at that time. And then when you saw the price surge in December and January, you saw even more. That metal then, you had a situation where outside of India, in India, investors were holding on to their metal and not selling. But in other parts of the world, including North America and Europe, you saw investors selling a lot of silver and some gold. And that metal then backed up, and the retail investors, the retail dealers, didn't have the credit availability to continue to buy stuff.
This is a lot of selling in the West, and I wanted to talk a little bit about the global nature of the gold and silver markets, because I've been hearing so much about China's increasing role in the market and in pricing, as well as the Eastern world in general. What would your comments on that be?
Silver's record highs hide a flood of profit-taking that Western investors often overlook. As Jeffrey Christian points out here, prices rising from $50 to $121 sparked mass selling, creating a credit crunch for retail dealers and temporarily suppressing demand. Meanwhile, Indian investors held firm, highlighting regional disparities and the global nature of supply flows. Rising Chinese influence complicates pricing further, but physical demand bottlenecks in the West remain a core constraint for markets. Next, Jeffrey Christian discusses how these flows intersect with Eastern markets and affect long-term silver liquidity.
China has been very important to gold and silver for years, and a lot of what I'm hearing is not accurate. Okay, the Chinese gold market, China's the largest mining country, China's the largest gold refining country, China's the largest gold market for investment products and investment demand, and it has been the case. And China has a policy, the gold in China stays in China. So it's been a very active market. In the silver market, it's also a very large producer. It's one of the largest. I don't think it is the largest mining country yet. It produces a lot of silver from domestic mines, from domestic scrap, and from imported concentrates, base metals concentrates, gold, copper, lead, zinc concentrates that they import. They refine it, they smelt it and refine it. They keep the copper, lead, and zinc, and then they have excess silver. So they're very important in the silver market. There has been a large changeover in the staffing of the Chinese government, which is part of the political situation going on in China. And that has apparently led to a hiccup in granting the 2-year export licenses for silver. And so you've had a situation in January and February where companies, refiners, and bullion banks, bullion dealers in China that had exported silver under 2-year licenses that expired at the end of December have been waiting for new export licenses.
China's dominance in gold and silver is often misrepresented in Western narratives. As Jeffrey Christian points out here, China controls mining, refining, and investment demand, yet policy keeps most gold domestic, and export licenses are delayed due to bureaucratic reshuffling, not market manipulation. Investors outside China misinterpret these gaps as deliberate shortages, while production continues and excess silver exists. Ignoring these subtleties risks mispricing exposure in global portfolios. Next, Jeffrey Christian unravels the real implications of export delays for supply chains and investor strategy.
That's just a mechanical thing, and it has to do with the political changeovers in China. But it's given an opportunity for the hucksters in the Western silver market to say, oh, China's withholding their silver. China's not withholding their silver. China is struggling to get its new export license people up to speed as to what they need to do.
Okay, and do we know if that has a point in time that it resolves? We just have to wait a little longer?
It appears to be resolving itself now.
Okay, so that's one misconception that
Yes.
we can talk about. There's a lot going on in the silver market that we should probably go over. The point that I've been talking to people with quite a bit here is the CME Group issue that we had last week at this
Yes.
point. And that follows the one that happened, I believe, around American Thanksgiving. We might have already talked about that one the last time we spoke. But I wondered if you could unpack that. There's a lot of concern about what that meant.
Yeah, there's a lot of theories that it was something nefarious. The reality is that precious metals and copper and aluminum are probably like less than 5% of the CME Group's turnover and have been neglected as a backwater.
Western narratives often exaggerate Chinese control to justify market panic. As Jeffrey Christian points out here, export delays are bureaucratic, not intentional, and the CME Group issues involve less than 5% of turnover in metals, yet speculation inflates perceived risk. Precious metals are the neglected stepchildren of financial exchanges, overlooked for decades while liquidity concentrates elsewhere. Investors need to separate actual supply bottlenecks from noise-driven fear, especially when small fractions of turnover drive headlines. Next, Jeffrey Christian talks about how this CME underinvestment impacts global market stability and trading behavior.
Precious metals and commodities in general have, when I started in the business 50 years ago, commodities were the major products of futures markets. Today, financial futures, currencies, stock indices, and other financial assets represent 95+% of the trading volume. So precious metals don't get advertising dollars, and they don't get tech support dollars. And from what we can tell, it's a matter of underinvestment. If you go back, I don't know, don't hold me to it. Let's say we go back 30, 35 years ago. COMEX did not belong to NYMEX, and COMEX and NYMEX did not belong to the CME group. And COMEX, which was gold and silver and copper, was not investing in new technologies and got to a point where it had a problem in 1987 and ultimately was bought by NYMEX because NYMEX had created the oil futures. It had the money to computerize in the 80s, and so it bought COMEX. CME, which had focused on financial futures, was a bigger behemoth, and it absorbed both of them. But the reality is that the metals markets, futures markets, have been the neglected stepchildren. They're the ancestors, And I hate to say it, but you just don't see the futures market, the CME group, spending the attention, including investing in new technologies and upgrading the existing technology that they should. And they don't, you have to be a cold-hearted capitalist and say, that's not where they're making their money.
Precious metals futures are the forgotten corner of a $95+ trillion financial ecosystem. As Jeffrey Christian points out here, COMEX and NYX historically underinvested in technology, treating gold and silver as stepchildren, while financial futures dominate liquidity. This neglect constrains transparency, delays execution, and hides operational risk from investors, yet mainstream narratives often ignore it. A 1987 technology gap illustrates long-standing structural vulnerability, with CME absorbing legacy systems but failing to modernize for metals. Next, Jeffrey Christian discusses how this underinvestment affects market efficiency and long-term investor strategy.
So, the gold and silver markets, metals markets, maybe we're not as big a deal as we think we are.
Right. Definitely not.
All right. I was wondering, so regardless, people are thinking something nefarious is going on there. Regardless of that, if we set that aside, there have been these two issues. Does that make entities less likely to want to trade on the COMEX? Do they want to take their business elsewhere, perhaps, with this going on?
I think the first impulse is to say, get your house in order. I mean, COMEX and NYMEX have the liquidity that other exchanges around the world just have not been able to develop. And, people keep having all of these inaccurate comments about COMEX versus Shanghai prices. The Shanghai Futures Exchange is a futures exchange that's designed for institutional investors, buy-side and sell-side financial institutions in China. Most of the physical silver goes through the Huatong Silver Exchange. Most of the physical silver goes through the Shanghai Gold Exchange. Shanghai Futures Market is a professional market for Chinese institutions. The COMEX and NYMEX are globally traded, including Chinese institutions, right?
Global liquidity often trumps perceived disruption in precious metals trading. As Jeffrey Christian points out here, COMEX and NYX maintain unmatched liquidity that other exchanges cannot replicate, despite fears of entities leaving over perceived issues. Misinterpretations comparing COMEX to Shanghai ignore structural differences. Most physical silver in China flows through Huatong and Shanghai gold exchanges for domestic institutional trading, not global settlement. This centralization preserves market depth, making exits impractical. Next, Jeffrey Christian talks about how this global liquidity framework affects trading behavior and investor confidence.
People around the world trade on the COMEX, and it's got the volume and the liquidity. So the first impulse, I think, of COMEX users is, please get your system fixed, because there really isn't somebody that we can turn to, that has that kind of liquidity. If you want, it's very similar to the US dollar. The world is flooded with dollars to the point where there's nothing that you can really say, well, let's shift to euros. If you shifted 10% of the dollar holdings on the world basis to the euro, European inflation would skyrocket because it'd be such a massive growth in liquidity. So that's why the dollar has this hegemonic, if I may use that term again, control on the currency market. As a Polish central banker said to me 45 years ago, if you owe a bank enough, you own it. If you owe the world enough, you own it. That's the way the US government thinks about the dollar. And in a similar microcosm, the COMEX and NYMEX are the places where there's the liquidity, and it would be a lot easier to fix them than it would be to try to create a replacement someplace else.
So there's no good equivalent.
No.
Very interesting.
Liquidity dominance can create a monopoly-like inertia in markets. As Jeffrey Christian points out here, COMEX and NYMEX provide a depth of trading comparable to the US dollar's global supremacy, making alternatives virtually impossible. Attempting to shift volume elsewhere risks destabilizing pricing, just as a 10% shift from dollars would distort European inflation. The analogy underscores why investors can't rely on smaller exchanges for equivalent liquidity, exposing structural rigidity often ignored in bullish narratives. Next, Jeffrey Christian discusses the implications of this liquidity concentration for strategic market decisions.
Thank you for explaining that as well. And on this note, there's been, surrounding all this CME Group issues that people have been talking about, there's concerns about the amount of people or entities standing for delivery of metal, and can that be done? And I think that's resulted in all these concerns about a default on the COMEX. So maybe you help us unpack that as well.
Well, yeah, it's very funny because, it's not an issue. One of the things people don't seem to understand, that when you take delivery on the COMEX, you're taking delivery of depository receipts. And a lot of companies, for a variety of reasons, will take delivery of the depository receipts, see what they're getting, and if they don't like the brand, they'll redeliver it the next day. And you don't have to pay 100% if you redeliver within 24 hours. So when you look at, say, 70 million ounces of deliveries in a given contract month, it's quite possible that the actual volume included was about 35 million ounces, because a lot of that stuff gets redelivered, and it gets redelivered again. It's depository receipts. So then you say, okay, so what's the relationship between the deliveries of depository receipts and warehouse deliveries, where the metal's actually coming out of the warehouses? And there really isn't a good correlation.
Physical delivery panic often overstates real risk in precious metals. As Jeffrey Christian points out here, COMEX deliveries are largely depository receipts that can be redelivered within 24 hours, meaning reported 70 million ounces may reflect only 35 million truly changing hands. Misreading this creates false narratives of default risk and market stress, obscuring operational realities. Investors who panic on delivery data risk overreacting, while the underlying warehouse flows remain stable. Next, Jeffrey Christian unravels the relationship between depository receipts and actual metal movements, clarifying the real market picture.
Now, if you go back to September, COMEX silver inventories were 530 million ounces. That was a record. And let me put that record in context. This is not like, oh, wow, he's got one more home run than Hank Aaron. This is a record where the typical volumes over several decades, until a couple years ago, were like 100 to 150 million ounces. And now you have 530 million ounces. Why did you have 530 million ounces in September of 2025? Because you had COVID lockdown, you had a shift to COMEX from other non-exchange traded things that didn't have clearinghouses. That started back in 2008, 2009, when the OTC markets locked up during the financial crisis, and people could trade on on futures exchanges because they had clearinghouses. And that has caused that. But then you had COVID, then you had people just sort of saying, okay, if I have physical silver, I'm a trading company, I have physical silver, I am more likely to find a buyer in North America than I am in Europe, either an industrial user or an investor. So it behooves me to have my inventories in New York rather than London or Zurich. So you saw that shift. Then we had this thing called Donald Trump, who came along, and you had all these people saying, oh my God, he's talking tariffs on everything. What if he puts tariffs on silver? So you had this flood of silver coming out of London and elsewhere, going into New York.
Record COMEX silver inventories in September 2025 tell a story few headlines grasp. As Jeffrey Christian points out here, the surge to 530 million ounces was driven by structural shifts, COVID lockdowns, post-2008 clearinghouse reliance, and North American preference for holding inventories, rather than sudden hoarding or market panic. Investors and industrial users naturally gravitated toward New York over London or Zurich for liquidity, while Trump's tariff chatter temporarily amplified flows. This illustrates how macro events and policy chatter distort perceived market risk versus actual supply dynamics. Next, Jeffrey Christian discusses the strategic implications of this inventory shift on trading patterns.
And it went from 150 to 300 to 530 million ounces, by which time Trump said, no, I'm not going to put tariffs on silver. Meanwhile, you had all these guys who love to be spurious and inaccurate saying, oh my God, London's running out of silver, right? Well, as London inventories of deliverable silver reduced, the London price rose relative to New York to the point where not only could you could buy in New York and sell in London and ship it back, you could buy in New York and fly it back to London profitably. So you had the situation peaking in September. You had the Fed saying we're probably going to be lowering interest rates more than we thought because the U.S. economy is looking weaker than we thought. So maybe investment demand and fabrication demand for silver is not going to be as strong in North America as it has been. And I can make money by moving the stuff back to London. And Trump just said he's not going to put tariffs. So you had COMEX inventories fall from 530 million ounces to 370 million, 380 million ounces. And 380 million ounces is still 3 times what the traditional level is.
Price divergence between London and New York created profitable arbitrage that few investors appreciate. As Jeffrey Christian points out here, even as COMEX inventories fell from 530 to 370 to 380 million ounces, the reality was driven by logistics and arbitrage, not fundamental shortage. Market chatter about London running out of silver exaggerated risk, while the Fed's rate guidance suggested demand could soften. Investors who panic over headline inventory swings miss the underlying efficiency and arbitrage mechanisms. Next, Jeffrey Christian shows how these arbitrage flows maintain market equilibrium despite apparent volatility.
And again, the spurious ones say, oh my God, you've never seen COMEX silver inventories fall 150 million ounces in just 5 months. And the answer is, of course you haven't, because it's never been that high. You know?
So we have to
When
take a
you
step.
only have 150 million ounces, you can't lose 150 million ounces, despite what they say.
So we have to take a step way back to understand this.
Inventory swings are misleading without historical context. As Jeffrey Christian points out here, COMEX silver fell 150 million ounces in 5 months, but the prior peak of 530 million ounces skews perception. 150 million ounces loss seems dramatic only against inflated baselines. Traditional levels of 100 to 150 million ounces make such losses impossible under normal conditions, highlighting how narratives can manipulate perceived risk. Investors must factor historical norms and structural inflows when evaluating market headlines.